Hello and welcome. My name is Mitch Klinski. I'm one of the investment advisors with Indigo Wealth Management. Today we're going to be giving you a basic overview of investing, and the presentation today is called Investment Basics, a guide to your investment options. In this presentation we're going to discuss many of the basics and fundamentals of investment planning. We'll start by discussing some of the fundamental investment concepts. Then we'll review some of the investment options that are available to you and consider some general investment strategies. Finally, we'll spend some time discussing how you might go about allocating your investment dollars. In the end, I hope that this overview will assist you in how you think about your own investment needs and may help you determine whether you might benefit from working with a financial professional. So to begin today, we're going to say, what does investment mean to you? Some people associate investing with speculating, gambling on a volatile or uncertain value of assets and hoping to obtain potentially higher returns. For example, trying to time the market, buying stock for a quick profit. Others may see investing as more of a long-term, methodical effort to save for the future. In fact, investing is a little bit of both. All investing does involve some certain level of risk, including the potential for loss. And there can be no ironclad guarantee that any investment strategy will be successful. So investing does involve the potential for growth of your money over time. Consider investing as a carefully planned and prepared approach to managing and accumulating money. Investment planning is about discipline and patience, but investing does not have to be difficult. A very important concept to understand when it comes to investing is the impact of inflation. Inflation has the effect of reducing your purchasing power of the dollar over time. According to the U.S. Department of Labor, the annual rate of inflation since 1914 has been about 3%. At a 3% annual inflation, something that costs only $100 today would cost $181 in only 20 years. So as you see on the slide, let's say you have $200,000 stashed away under your mattress. Assuming a 3% annual rate of inflation, that $200,000 will only buy you $108,000 worth of goods or services in 20 years, and less than $60,000 in 40 years. This means that if your investments are not keeping pace with inflation, they are actually losing purchasing power. It also means that the real rate of return on your investments may be less than you think, something that you also have to think about over the long term. While inflation has the general effect of reducing the real value of your investments over time, compounding has the exact opposite effect. Anyone who has ever had a savings account understands the basic of compounding. The funds in your savings account earn interest, and that interest is added to your account balance. The next time the interest is calculated, it's based on the increased value of the account. In effect, your interest is earning interest. So when you look at the slide, you see if you invest $5,000 a year for 30 consecutive years, after 30 years, you would have invested a total of $150,000. Now, once again, assuming that your funds grow at exactly 6% each year and not taking taxes into account as well, because of compounding, after 30 years, you would have about $395,000. So you went from $5,000 a year for 30 years, that would be $150,000 of investments, all the way to almost $400,000 in 30 years. That's a pretty good gain. Now, if you want to calculate what kind of return you need for any amount to double, the rule of 72 comes into handy. It's a very quick way to estimate how long it will take for any investment to double in value through compounding. Divide the number by 72 by the rate of the investment that you wish to get, and the result will be the number of years it will take for it to double. For example, if the expected annual return of your investment is 3%, it should take about 24 years for it to double. You can also use this rule to estimate the number of years that it would take given a rate of return. So, for instance, if you want your money to double in 4 years, you would actually need about an 18% rate of return. So the rule of 72 comes into effect both in looking at the rate of return you need and also the amount of years that your assets might double. It's been said that it's time, not timing, that is most important. So the sooner you start investing, the more time your investments have for potential growth. Waiting too long can always make it very difficult to catch up. For example, if you look at the slide, while investing $3,000 a year at the end of each year, if you start when you're 20 years old and invest all the way to 65, assuming a 6% growth rate and no tax, you'd have almost $680,000 at 65. Now, if you wait until 35, that's 15 years later, and started investing the same $3,000 a year, you'd have a little over $250,000. And if you waited again to your 45 and invested to your 65, you'd have about $120,000 after 65. So my point is that it's never too late to get started. The best time to start is now. The sooner you can start and have compounding benefit your investments, you'll be better off in the long run. The first step to any investment plan is to identify your goals. What are you really investing for? Many of us invest to accumulate funds for retirement, or possibly for a child or grandchild's education. Others invest for short-term goals. Perhaps you want a down payment on a home or a new car. Still, others invest to build a fund to have in case they have any unanticipated expenses, like an illness or job loss. Of course, you may have many of these goals at the same time. If you do have multiple goals, think about how you want to prioritize the goals. Once you've identified and prioritized your goals, consider the time horizon associated with each goal. Generally speaking, with everything else being equal, the longer your time horizon, the more aggressively you might want to invest. That is, investments that carry more risk because they have greater potential return also tend to be more appropriate for longer-term investment horizons, more so than people who have short investment horizons. Why? The reason is because with a longer time horizon, you have more time to recover from losses that might be shorter term. The world of investing is very subjective. The investment plan that's right for you depends largely upon the level of comfort that you have when it comes to risk. You can't completely avoid risk when it comes to investing, but I believe it is possible to manage risk. There are two aspects of risk tolerance that you really want to consider. First is the capacity of your plan to absorb investment losses itself. And the second is how comfortable you are assuming that risk. The first aspect can be quantified. The more flexible your investment plan has when it comes to potential loss, the more risk you can tolerate. For example, if we're discussing somebody that has a very long-term time horizon, you might be able to take more risk than somebody that has a short time horizon. The second aspect, how comfortable are you personally with risk, is much more of an emotional measure, as it depends on many factors, including your objectives, your life stage, personality, investment experiences. Some investors are comfortable with a high degree of risk, while others can only tolerate a very minimal amount of risk. Investors are typically grouped into three categories when we're discussing risk. First, you have aggressive, those people that are willing to take a high degree of risk. Moderate investors are willing to take some risk, but they also have an eye on trying to be more conservative as well. Then conservative investors would be the people who really don't want to take a lot of risk and really have an eye on being more risk averse. The chart that you see here, I would call a chart that measures both risk and potential reward, or standard deviation. When it comes to investing, there's a direct relationship between risk and return. That is, in general, as the potential for returns increase, so does the level of risk. Or stated another way, the less risk an investment has, the lower potential return it should have as well. So for example, putting your money into a bank CD will have very little risk. It also offers very little return. So this is true for investment portfolios as well as different investments. The more aggressive you are as an investor, the more risk you're willing to take, means the greater your potential return, but also the greater chances for loss. Conversely, the more conservative you are as an investor, the less risk you're generally comfortable with and lower potential returns. That is always known as the risk-return trade-off. As much as we would like it, we can't have it all. There's a relationship between growth, income, and stability. And the closer we move to any one of these, automatically, the further we move to the other two. This dilemma is what all investors face. The key is to try to maximize the returns at any level of risk that you're in. There are several different categories of investments to choose from, and countless specific investment options within each category. We're going to discuss today cash alternatives, bonds, stocks, some other investments, and funds. Before we start talking about different investment options, let me take a moment to clear up a common misconceptions. Many people think of a 401k or possibly an IRA as an investment. Well, 401ks and IRAs are accounts. They are not investments. Think of these types of accounts as buckets that hold your investments. So we're not going to be talking about tax treatment today. We are going to be talking about different investments, but it is very important to consider tax advantage investing as well. And utilizing 401ks and IRAs are a good way to help benefit your plans in the long run. So the first investment that we're talking about will be cash alternatives. Cash alternatives are relatively low risk short-term and generally fairly liquid. In other words, you can convert them to cash quickly if you need. You might use cash alternatives to provide relative stability in your portfolio and to maintain a relatively easy access source of cash in case of emergencies or other purposes. Cash alternatives can also be used to provide a temporary parking place for your assets until you decide where you want to put your money. Some types of cash alternatives might include certificates of deposits, money market deposit accounts, money market mutual funds, and U.S. Treasury bills, otherwise known to as T-bills. The advantages of using cash alternatives are evident. You receive reliable, predictable earnings, otherwise interest, and it's an easily source for you to go and get your principal if needed. The big trade-off here, though, is that you'll receive very low return for accepting your low risk. So bonds would be next on the totem pole when you look at how much risk you want to take and hopefully getting a little bit better return. Bonds are essentially loans, which is why they are typically called debt instruments. You as the investor will lend money to a government or corporation. The interest rate or coupon, which can be fixed or floating, is set in advance, and interest payments are generally paid semi-annually. Bonds are issued in denominations as low as $1,000. In addition to a set interest rate, which sometimes can fluctuate, the maturity date is fixed as well, ranging from 1 year to 30 years. However, bonds don't need to be held until they mature once they're issued. They can be traded among investors, all the time. Because you can buy and sell bonds in the open market after they are issued, bonds will fluctuate in price, selling a bond possibly below or above their face value, what you might have paid for it. If interest rates rise, new bonds and investment options are offered with higher rates, and existing bonds with lower rates become less appealing. So when rates rise, existing bonds generally decrease in value. In contrast, when interest rates are falling, existing bonds become more valuable and increase in value. Generally, the longer a bond's duration to maturity, the more volatile it'll be with price swings. The most common types of bonds include U.S. government bonds, agency bonds, and also municipal bonds, as well as corporate bonds. U.S. government bonds and securities are backed by the full faith and credit of the U.S. government, and therefore are the safest bonds and carry very minimal risk. We have already talked briefly about U.S. Treasury bills or T-bills. Other Treasury securities include T-notes or Treasury bonds, which also pay interest semi-annually, but those are a little bit longer duration than T-bills. You can also invest in bonds that are issued by government agencies or sponsored by the U.S. government, which may or may not have backing by the U.S. government, depending on the agency. Municipal bonds are issued by local governments, cities, and towns. Specific authorities like a state transportation authority may also issue bonds. Corporate bonds are very popular and are issued by private companies. The volatility of these bonds depend upon the companies that issue them and can range from very stable to highly volatile. So the volatile ones are called high yield or junk bonds. Some corporate bonds are convertible and can be exchanged for shares of company stock. Those are convertible bonds. You can also purchase zero coupon bonds that are issued at a discount, below face value. No interest will be paid in a zero coupon bond, but at maturity, you would receive the full face value. For example, you might pay $600 for a 5-year, $1,000 zero coupon bond. At the end of 5 years, you would receive the full $1,000 after paying $600 5 years earlier. So you don't get interest, but you do receive the higher benefits when the bond matures. So what are the pros and cons of bonds? Bonds aren't as safe as cash alternatives, nor are they as glamorous as stocks or commodities, but they are a very important part of an investment portfolio. Bonds can provide steady and predictable stream of income through interest payments for as long as you hold them. In addition, income from the interest payments is typically higher than cash alternatives. Bonds are also generally considered relatively low risk. Because bonds are legal debt obligations, corporations must pay interest to bondholders before paying dividends to shareholders. Further, in the event a corporation declares bankruptcy or dissolves, it is obligated to pay bondholders before stockholders. And of course, securities issued by the Treasury are backed by the full faith and credit of the United States. However, all bonds do carry some risk. And some bonds, especially high yield or junk bonds, do carry a great deal of risk. Bonds may also help you diversify your portfolio. Bonds tend to move in the opposite direction of the stock market. So by holding both bonds and stocks in your portfolio, you might be able to offset losses in one category with a gain in the other category. With bonds, you can lose money though as well if the bond issuer fails to make interest payments or is unable to repay the principal. Bonds are also issued with a fixed interest rates. In general, the interest rate might fluctuate at an adjustable rate, so too can the value of the bonds. So when you think about investing, many people think of stocks. We're going to talk on this slide about stocks. When you buy company stock, you're actually purchasing share or ownership in the business. The greater the number of shares you own, the higher percentage of ownership you have of the company. Your percentage of ownership of the company also represents your share of the risk taken and profits generated from that company. If the company does well, your share of the total earnings will be proportionally to how much stock you own. On the flip side, if the company does poorly, your proportionate risk will be the percentage of ownership that you have of the company as well. Beyond that, depending on the company and type of shares that we have, stock ownership can carry other benefits. Specifically, if you're entitled to dividend payments, which you can either receive as cash or possibly reinvest and buy additional shares. Capital gains payouts and other corporate privileges are other examples. If you purchase stock, you can make money in one of two ways. First, corporate earnings distributed in the form of dividends, usually paid quarterly. Secondly, you can sell your shares if the value of the company's stock increases at a profit. Of course, if the stock declines, you would have a loss. Generally, corporations issue two types of stock, common stock and preferred stock. Common stockholders hold many rights, including the right to vote. However, common stockholders are last in line to claim the earnings and assets of a company. They receive dividends at the discretion of the board of directors and only after all other profits have been satisfied. Preferred stockholders are given priority over common stockholders when it comes to dividends and assets. However, preferred stockholders do not have the right to vote. Preferred stockholders have less risk than common stockholders, but there's also the less opportunity for growth. Stock is commonly categorized by the market value of the company of the issuing company. For example, large cap stock describes stock that is issued by the largest corporations. Other general categories would include small cap, mid cap, and or micro cap from very small companies. Stock is also commonly classified according to the characteristics of the company. For example, growth stocks are usually characterized by increasing faster than the industry average. Value stocks typically categorized by selling at a low multiple of a company's sales, earnings, or book value. And income stocks generally offer higher dividend yields than the market. Also worth mentioning are advanced depository receipts, or ADRs, which are actually the stocks that are issued from non-U.S. companies. Some of the advantages and disadvantages of stocks largely depend on the actual stock that you choose. In general, though, stocks offer greater potential return than do bonds or cash alternatives. Historically, this has been particularly true over long-term periods. With stock, you actually own a share of the company and therefore have ownership rights that include voting rights. You can invest in a stock that has a history of paying regular dividends, oftentimes for many decades, and you can also invest in stock that has the potential to appreciate greatly in value. And stock is very easy to buy and sell. Of course, there are disadvantages, and if the company that you invest in performs poorly, it may not pay dividends, even if it had regularly paid dividends in the past. More importantly, though, poor performance can result in you losing share value. In fact, your shares can lose value simply because they're subject to general volatility of the stock market, which has definitely experienced a lot of price fluctuations in the past. It also means that stock may not be appropriate for short-term investors because of the volatility versus long-term investors. Cash alternatives, bonds, and stocks are the three major investment groups, but there are some other options that you might also consider. Real estate, both commercial and residential real estate, and real estate investment trust or REITs, stock options, futures and commodities, which amount to speculating on the future value of something, like gold, sugar, wheat, or corn. Also collectibles, such as antiques, fine arts, cars, baseball cards, stamps, coins. Those as well can appreciate over the years. But since this is an investment basics discussion, we're going to stick to the main three with stocks, bonds, and cash. Mutual funds are very popular, and mutual funds represent another way to invest in stocks, bonds, and cash alternatives. The principle behind a mutual fund is quite simple. Your money is pooled along with the money of other investors into a fund, and the assets of the certain securities which are stated in an investment strategy. The fund is managed by a fund manager who reports to a board of directors. By investing in a fund, you own a piece of the total portfolio, which could include anywhere from a few dozen to hundreds or possibly thousands of securities. This provides you both a convenient way to invest and possibly obtain professional money management, getting instant diversification that would be very difficult to achieve on one's own. Every mutual fund publishes a prospectus. Before investing in a mutual fund, get a copy and carefully review the prospectus, which should contain the fund's investment objectives, risks, fees, and expenses of the fund. We've discussed the three major investment categories with cash alternatives, bonds, and stocks. Many mutual funds limit themselves to just one of those categories, commonly known as classified according to the investment objective. Funds that invest solely in cash alternatives are generally called money market funds. Funds investing solely in stocks are stock funds, and not surprisingly, funds that invest only in bonds are bond funds. Stock funds can also be classified on the size of the companies for which they invest. Large cap funds, mid cap funds, small cap funds, and micro cap funds. Of course, there are many types of mutual funds. For example, funds that invest in both stocks and bonds can be called balanced funds or hybrid funds. In fact, there are many mutual funds that invest in the whole spectrum of investments. There's also international funds which seek investment opportunities outside the United States. An actively managed fund is a fund where the fund manager uses his or her own knowledge and research to actively buy and sell securities, hopefully with an attempt to beat the benchmark or minimize risk. A passively managed fund or an index fund typically buys and holds securities represented in an index, such as the S&P 500 or the Dow Jones Index. The objective of an index fund is to obtain the same return or mimic the return of an investment. Although the name of a mutual fund can sometimes offer insight as to the style and objective, don't rely alone on the name. Take a look at the prospectus and make sure that you understand the investment before you invest. Mutual funds do offer several advantages, one of which, and one of the most popular, is diversification. Most mutual funds own dozens or even hundreds of different investment securities. Managers often spread the risk of assets over more than one industry or even different types of investments, though diversification alone cannot guarantee a profit or insure against a loss. Holding many different securities, will be more secure than just putting all your eggs in one basket. Professional money management, full-time expertise is part of what you pay for when you buy an actively managed mutual fund. The fund's manager analyzes hundreds and thousands of securities and buys and sells what he feels would be in the best interest of the fund. Also, mutual funds, often you can get in with very low dollars. Depending on the fund rules, you can open an account and make subsequent contributions with as little as $50. You can even set up automatic payments monthly, quarterly, or semi-annually out of a bank account. Mutual funds can also offer liquidity. You could convert your mutual fund investment into cash relatively easy by making a request in writing, over the phone, online, or through your advisor. On the other hand, there are some disadvantages. Mutual funds are not guaranteed investments. The price of a mutual fund can change daily, and you will receive the current value of the shares when you sell, regardless of what you paid, which could be more or less. In addition, because investors of a mutual fund can withdraw their funds at any time, mutual funds tend to keep some of their portfolio in cash. These funds can be invested in other options if you were doing it yourself. Fund managers don't take into account your individual circumstances. This can lead to some inefficiencies when it comes to taxes. For example, short-term or long-term gains can be part of a mutual fund and will be passed on to the shareholders. A popular way to invest is also using exchange-traded funds. Like mutual funds, an exchange-traded fund pools your money with other investors. However, there are some key differences that you need to understand when investing in exchange-traded funds. Unlike actively managed funds, exchange-traded funds typically select investments according to an index, once again like the S&P 500. The fund's investments typically don't change unless the index changes. That passive approach, relatively infrequent trading, can help reduce the fund's cost. So you'll typically have lower management fees and research, and you'll be less trading activity within the fund. Even if ETFs or exchange-traded funds have a passive approach, they can be very useful investors who want to trade actively. ETFs trade throughout the day, where mutual funds only trade once a day. Finally, because mutual funds are traded infrequently, ETFs will offer tax efficiencies. For example, they will make lower taxable annual distributions to the shareholders. Like a mutual fund, ETFs do have prospectuses, so review the prospectus of an ETF before you decide to purchase. Many investors utilize an investment strategy called dollar cost averaging. With dollar cost averaging, rather than investing a single lump sum when you invest smaller amounts of money at regular intervals, no matter how the market is performing, your goal is to reduce the overall volatility of your portfolio when purchasing more shares when the price is low and fewer shares when the price is high. Although dollar cost averaging can't guarantee you a profit or ensure that you won't lose money, a regular fixed dollar amount investing can result in a lower average price over time, assuming you invest in good and bad times. You should consider your financial ability to make ongoing purchases when starting a dollar cost averaging plan. Let's say, for example, that you decide to invest $300 a month towards your investment goal. Because you invest the same amount, the $300 each month, you will automatically buy more shares when the price is low and fewer shares when the price is high. Over time, you'll find that your average cost per share might be less than if you would have just bought when you wanted to. If you're contributing automatically to a 401k or a systematic plan, you're already participating in a dollar cost averaging strategy. It is almost universally accepted the concepts of any portfolio should have a wide mix of investments. That is, a portfolio should contain investments from all different types of risk categories. Many investors make the mistake of putting all their investments in one basket. For example, if you invest in one stock and that stock goes through the roof, a fortune could be made. On the other hand, that stock could lose a lot of value, resulting in a total loss of your investment. Diversifying your investment over several asset classes can help reduce the risk of losing your entire investment. Keep in mind, though, that diversification cannot ensure a profit or guarantee against a loss. Asset allocation is one of the first steps in creating an investment portfolio. Asset allocation is the concept of deciding how much you should put in the different asset classes, such as stocks, bonds, or cash. The underlying principle that different asset classes have shown different rates of returns and price volatility over time. And since different asset classes respond differently to the same news, your stocks might go down, but your bonds might go up, and vice versa. Diversifying your investment over different asset classes might help reduce volatility of your portfolio. So how do you choose the right mix? A number of resources are available, including interactive tools and sample asset allocation models. Most of these take a number of variables. Some objectives, like your age, your financial resources, and your time frame and need for liquidity, are very important. Every individual situation is unique. Nevertheless, in general, conservative investors and a conservative asset allocation strategy will invest heavily in bonds and cash alternatives, with little in stocks. Therefore, the primary goal is low volatility and preserving your principal. In comparison, a moderate asset allocation model will attempt to have a balance between income and growth by allocating an even amount in both cash with bonds and also stocks. It might not always be 50-50, but a balanced or moderate asset allocation will have a general mix of both. Finally, an aggressive allocation model will tend to concentrate heavily on stocks, focusing primarily on growth. As you've seen, there's a lot to continue. As you've seen, there's a lot to As you've seen, there's a lot to consider when it comes to investing. If you don't have the time, confidence, or inclination to put together an investment plan, you might benefit from the help of an investment advisor or financial professional. A financial professional can help you do many different things. First, help you determine your investment goals, time horizon, and risk. Evaluate market and investments that are appropriate for you. Create an asset allocation model that would meet your risk tolerance. Selecting specific individual investments and managing and monitoring your portfolio. And keep in mind that your portfolio is trying to help achieve your overall goal in the long run. So today I hope you learned a lot about investment basics. Once again, my name is Mitchell Klinski with Indigo Wealth Management. Feel free to reach out to me at 847-538-4491 or contact Indigo